My friend, trading is not about just picking the right stocks, it's about managing risk and protecting your capital. If you don't get this, even the best strategies will fail. Today we are diving deep into the risk management and money management, the two pillars that separate successful traders from broke gamblers. Most traders blow up their accounts not because they pick bad stocks, but because they risk too much on a single trade. Imagine betting 50% of your capital on one single trade and it goes wrong. Game over. Now here is one golden rule. Never risk more than 1 to 2% per trade. Let's say you have rupees 10,000 in your trading account. If you risk 1%, that means your maximum loss per trade should be rupees 100. Even if you lose 10 trades in a row, you still have 90% of your capital left to recover. For example, your account size is rupees 10,000 and risk per trade is 100 rupees. Stop loss calculation, let's talk about that. If a stock stop loss is rupees 2 below your entry price, you should buy 50 shares, that is 100 rupees divided by 2 rupees. Now position sizing. What is position sizing? How much to buy? Most beginners makes the mistake of buying too many shares. Instead, use this formula to calculate your position size. Position size is equal to risk per trade divided by stop loss distance. Example, you have 20,000 in your Demat account. You follow the 1% rule. So risk per trade is equal to rupees 200. So let's say stock XYZ is trading at rupees 50 and your stop loss is at 48 rupees. That is 2 rupees risk per share. Now position size is equal to rupees 200 divided by 2 rupees, that is equal to 100 shares. This ensures that no single trade can destroy your account. Then comes to risk reward ratio, the key to consistent profit. A profitable trader do not need a high win rate. They need a high risk to reward ratio. Here's one golden rule. Always aim for at least 1:3 risk reward ratio. If you risk 100 rupees, you should aim to make at least rupees 300. This Obviously this way, even if you win only 30% of your trades, you still make money. Let's take an good example. Trade 1, you lost 100 rupees. Second trade, you lost 100 rupees. Third trade, you won 300 rupees. And fourth trade, you won 300 rupees. Total losses 200. Total wins 600, even with a 50% win rate. This is why professional traders focus on risk reward, not just accuracy. Now let's talk about stop loss and trailing stop loss, your safety net. Stop loss is a price level where you exit automatically if the trade goes against you. Trailing stop loss locks in profits by moving with the trend. Example of a trailing stop loss. See, you buy a stock at rupees 100, set a 10% trailing stop loss. If the stock rises to 120, your new stop loss moves up to rupees 108. If it falls back to 108, you sell and lock in your profits. This technique protects gains while allowing your wins to run. Last but not the least, diversification. There is a saying, do not put all your eggs in one basket. Never put your entire capital in one stock or one sector. Diversify across different industries and different asset classes. For example, instead of investing 100% in tech stocks, split into 50% stocks like tech, pharma, banking, 30% in gold and bonds, and 20% in cash. This ensures that if one sector crashes, you do not lose everything. Final thoughts, the key to long-term success: risk small, win big. 1-2% risk per trade is enough. Calculate position size properly, always use stop loss, and follow the 1:3 risk reward ratio. Diversify your portfolio. Most traders fail because they focus on finding the next big stocks instead of managing risk properly. If you master this, you'll stay in the game long enough to win. Now a question for you. What's the biggest mistake you made in trading? Let me know in the comment section. If you found this video useful, like, comment, share and subscribe the channel, because trading is a game of survival, not just profits. Thank you. See you in the next video.